Good morning. Welcome to the Women's Symposium of Southern California. This is our inaugural semi-annual Women's Symposium. Thank you for joining us. We're going to get into a lot today, and I'm very excited to let you know that my name is Mara Feinberg-Cook. I'm a certified financial planner and founder of this organization. We are a nonprofit 501c3, 100% volunteer operated, and pro bono volunteers and professionals come together to help women improve their lives. So today we're going to be doing a lot of really focused conversations on financial planning, empowerment. You know, are we doing the best things and making the best decisions for ourselves? And so we'll see and give you some really good tips. We will be recording today, and also please be on a respectful behavior as we all have different backgrounds and viewpoints. Thank you so much. October is National Women's Business Month. Women's Symposium has taken on the challenge to help celebrate and recognize small businesses that have been founded by women. And I wanted to take the time to really articulate that. I think it was in the 70s, women-owned businesses were about 4%. Now women-owned businesses are well over 40% of United States entities today. And a very, very exciting time to celebrate. If you're a woman business owner, congratulations. And we are here to celebrate your accomplishments and support your financial goals over time. Women's Symposium is an organization historically around International Women's Day. We do celebrations. This year's theme was Choose to Challenge. And we were doing that by growing our programs, including this mini symposium and the Empower Web Mentorship Program. A little bit about what we're going to do today. In a few moments, I'll be introducing our keynote speaker, Megan Dosher, and then we'll have a speaker, Meg Bavero, who's a specialist in investments. And we're going to have a dynamic conversation on finances, exciting trends with women today, and the next step above cash investments is fixed income investments, the who's, what's, where's, when's, and why's. I'll allow some Q&A with both of our keynote presenters, and then towards the end of the presentation, we will ask you to fill out an evaluation and visit our sponsor exhibitor booths. We will also have an Empower Web Mentorship by Wssc session open so that we can answer your Q&A about that as well. Definitely would not be here without our Women's Symposium of Southern California sponsors. I'm talking about companies and organizations that really choose to align their business marketing dollars with women's empowerment. And I definitely want to thank the two participating speakers and sponsors today from Bright House and PIMCO. We are 100% volunteers, and there has been multiple women this summer that have added in their time and so forth. And I do want to thank them. That slide went a little bit fast. We're going to bring that back in. And I just want to say thank you to these women, because without their leadership and time, we would not be here today. So owning your own journey is our theme today. And I just have to say, what does that mean to me? Owning my own journey. Pardon me, all my computers are, I got to own this. I'm owning my journey. Essentially, that means putting my mouth where, putting my money where my mouth is. Taking responsibility. Doing everything that I can to say that I tried. And owning my own journey is something that is important for me to feel accomplishments, for me to help my family, for me to help the community. We have a program for you embedded. There's a link in the chat, so you can have a copy of the agenda as well. And just want to go over a little bit of logistics. Let's see here. If you have any troubleshooting issues on Hopin, we have a help desk support in our sessions. You can also text or chat. We'll be responsive as possible. And also, our expo booths will be open after the event. You can visit both of our speakers' expos, and let's see, video on presenter mode. I don't know. Let's see. I'm getting some information here. Thank you for helping me. I don't know if we can do a speaker mode. There's a little bit of tech, but we're going to get this right back up and it'll be great. All right. So when we help ourselves and we help our community, we're actually pushing the agenda forward for gender parity. And I'm really excited that essentially, if we don't plan, we're going to find ourselves in a place we don't want to be. And it feels good to plan and fill those gaps in our lives. Try to implement small and manageable steps so that we can feel secure in our lives and have well-being long-term, essentially financial independence. For some time today, for some people it could be tomorrow, but you know, if you can see that change and learn a few things today and implement them and have that aha moment, I got it, then you can start to feel the incremental change towards empowerment and success. There is a place for overall well-being by listening to others in educational forums in situations like this, learning from my mistakes, seeking peer counseling, learning from others is really where the magic happens with women. And that's where this forum is for us today. We also recognize our Purple Diamond Award winners. These are women, specific in Southern California, who have pushed the needle forward. All right. I don't know if you can see me or the screen, but let's see. All right. See if we can get this back up. Thanks for working with me, you guys. Women's Symposium, through our evaluations earlier this March in our annual Women's Symposium, it was apparent that our attendees wanted more on finding their purpose. So Women's Symposium is launching the Empower Web Mentorship Program today. And we're going to have a session. You can talk more about that with us. But when personal connections are at an all-time low in COVID and national pandemic, it's important that we get together and help each other, whether it's a peer-to-peer or mentor-up situation. I'm excited to say that the Dean of DeVry Long Beach, Laura Knapp, will be starting the pilot with us. Samjita Mitra, the chief economist at the state of California, as well as myself and a few other Fortune 500 company executives. Really excited about this. So what we're going to do is we're going to have a kickoff in a week, and we're going to ask participants to meet at least 1 hour per month with their mentor over the next few months and see what kind of impact we can bring. And then we'll have a closing forum. technology is way too important to really leave women out of it. And so it's important that essentially we take those seats at the table. There's a lot on the line today with cyber attacks on the rise, a global pandemic, what's right for your own health, what's not right, all these supply chain shortages worldwide, not to mention tremendous inflation on all levels. Just check Costco out, and our leisure expenses, and everything's going up. So we hope that today you enjoy our keynote speakers and just take a little something away that can take the edge off of life and help you navigate your financial waters that we're all boating through together. We will be general in nature, and then we'll get more specific on investments later on. Hang in there if there's a few things that don't make sense, or if you have heard a new term for the first time. We are improving your life together. We're improving our community's life through financial independence, and we're delighted to have you here to join us in the conversation today. Without further ado, I do want to introduce our keynote speakers. And Meg, I will be with you in a minute. There's a toggle issue here, but I do want to introduce you. But I wanted to show your beautiful picture. Megan Dosher is the Senior Vice President and Chief Marketing Officer of Bright House Financial out of, well, her virtual office right now, but headquartered in North Carolina. She is going to be talking on tremendous trends with women today. And she is the, let's see here, I apologize. Megan is the Chief Marketing Officer for Bright House, and Bright House is a Fortune 500 company, one of the world's largest providers of life insurance and annuities for solutions. Bright House Financial was established by MetLife, remember Snoopy, in 2016. In this role, Megan is responsible for the company's marketing, branding, strategy, and she closely partners with others in her organization to drive business and develop opportunities for top-line revenue and growth. She also oversees sales enablements, strategic data analytics, and insights in digital platforms, focusing on growing the Bright House financial market share. She has previously served as a vice president for compensation and business initiatives for MetLife's U.S. retail business, with responsibility for leading sales comp admin in the United States for all advisors and brokers. I think it's a good time to bring up Meg. Here we go.
Good morning. Good afternoon for those on the East Coast. Can you hear me okay?
Yes.
Excellent. Great. Well, thank you, Mara, and thank you, Women's Symposium of Southern California. And I'm so happy to be here with all of you this morning, this afternoon. I applaud all of you for taking the time today to take the first or maybe second and third steps toward owning your journey of financial wellness. Our goal today is to hopefully start to chip away at some of the financial basics. So when I speak with so many of my female friends, they hear finance and just zone out. It's like one of those taboo topics that we don't really talk about. There's sometimes a lot of big words, confusing words that are used. And we're going to do our best today to kind of take that all away. We're going to debunk that this is complex. And at the end of the day, I am very hopeful that you can walk away with a few actionable steps to make sure you're controlling your journey and really owning your journey, quite frankly. A few things I like to say up front before we dive in. I really like to hit it head on. So if you remember nothing else from my presentation, I wanted to start with 3 key topics, I guess. Then we'll peel back the onion a bit and I'll ground you in some data so that, more for awareness. I'm a big fan of not putting our heads in the sand and just being aware of, what we potentially could be facing. And then toward the end, we will revisit some actionable steps you can take to just feel a little bit more well financially. So first and foremost, you own this, you got this. Like, do not think this is super complicated and complex. I think as women, we're prone to sometimes default to, oh, I don't get this, or I wish I knew more about it. And there's some kind of embarrassment around it. And at the end of the day, people should be able to explain it to you in plain English. I'm a huge fan of financial professionals. Mara's one of our favorite financial professionals that our wholesalers work with. But, it's a phenomenal, noble industry. And it's what they do for a living, right? There are people out there who can help guide you through this in a simple way without making you feel like you need some kind of advanced degree to understand it. It's pretty basic, and there are many people that do a phenomenal job explaining this. And if you don't feel like you have the right financial professional, it's like dating. You can go find another, right? So we'll get into that a little bit in a few minutes. The other thing I'm going to touch on today is knowledge and transparency are power. So if you're in a relationship, you're married, or you share assets with someone or share money with someone, make sure you know what's coming in and out. Make sure you know where your money is. If you're working female, make sure you know what your company offers. A lot of companies provide benefits to you. So just make sure you know what's available to you, and start to make a list of everything you have financially. It's a great place to start. And then you can take a step back and say, what might be missing? What do I need? And sometimes you don't need everything. Less is more. And we'll talk about that a little bit more as well. Last but not least is inserting reality. So a lot of my friends, and rightfully so, and I've been in this situation too, where you feel like the bills are piling up, and the thought of even saving, let alone, making ends meet, it's just overwhelming. And there's just a lot of information out there. There's information everywhere these days, from TikTok to Instagram to the news. It's just, there's data everywhere. So for me, the best way to think about this is actually start paying attention. So maybe for the next month or two, just to pay attention to where you're spending your money. For me, it's all about risk reward and return on your money. You work really hard for your money, like really hard. We deal with crazy bosses and balancing and juggling everything. So we want to make sure we know where we're spending it, and is it worth it? And I'll give you an example of this, and it's a little silly, but it's true that small things add up. So early in my career, I think I was reading Cosmo magazine or something, and they mentioned that a lot of people spend $1,200 a year on coffee. Like if you buy like one caramel macchiato or pumpkin spice latte a day or something, you're spending over $1,200 a year. And I paused because I love coffee, and I definitely was buying at least one in the morning, and I'm sure I was buying one in the afternoon, and very quickly realized I was spending over $2,000 a year on coffee. So I love coffee, but for me, I like any coffee, and the reward for me just wasn't there. So I decided I was going to brew my own coffee, grab one caramel macchiato on the weekend. And at that time, that was a meaningful savings to me. When you think about $2,000 a year, that's definitely enough to start to build up some savings for a rainy day, or buy, part of a nice insurance policy for your family. And to me, the caramel macchiato just wasn't worth it. It might be worth it to you, and that's totally fine. But it's really just making sure you're not leaking money without realizing it. And, just make sure you're paying attention. And that's really more than half the battle right there. So we're going to dive into this a little bit over the next few minutes. So with that, I am going to attempt to share my screen. Hopefully we can do this. Let me know if you can't see this. Mara or Cheryl, if you could text me if you can't see it. But right now we're going to talk about owning our financial future. And I'm going to throw out some data And we're going to do some celebrating, and then we're going to ground ourselves in some additional facts just so we can plan accordingly. So I call it Super Women Today. We just have to take a pause on this. Every time I read this slide, I get goosebumps and just, beam with pride. Women own over 12 million firms responsible for generating almost 2 trillion with a T dollars in revenue. We control more than half the private wealth in the United States and are responsible for 80% of all purchases in the US. So we are controlling the wealth, where it's spending. We make the world go round, right? We knew that, but we're really fueling the economy, which is pretty cool. We also earn over half of all bachelor's and advanced master's degrees. And we should be really proud of that. We're also on deck to inherit 70% of the wealth transfer over the next 2 generations. So when you think about your parents, and I know you don't want to think about it, but your parents and possibly grandparents and those generations, or your children, if you have children, they're going to be inheriting a lot of money. And we want to make sure they're prepared to handle that responsibly, right? Women in all seasons of life need to think about this. So maybe you used to work and you've stepped out of the workforce to raise children or care for an aging parent or family member. Maybe you're almost retired or are retired. And there's everything in between, right? So we all need to be mindful of what our own situation is, because everyone's is a little bit different. And, what is right for me may not be right for Meg or Mara or one of you, right? And that's where, financial planning really comes into play. So you don't need to figure out alone. That's the good news. Financial professionals can help. And there's many resources, including one I put in the expo, of questions to ask when you're trying to find a financial professional. Again, we mentioned Mara is one of the top financial professionals who will be recognized in Fortune 500 in November when that issue comes out. But there are many financial professionals across the country who can help. And I know when I speak with others, sometimes they think, well, gee, like if for some reason in their head, they think I need $10,000 to pay a financial professional for help. And that is not the case. That is actually one of the questions. You can ask a financial professional, how are they compensated? Many financial professionals are there to guide you and build out a plan, and you can just pay for a plan to execute on, or you don't have to pay unless you're actually purchasing a solution. So you can kind of figure out what kind of professional best suits your needs, given where you're at and what your asset profile looks like. There's many different things financial professionals can help you with. Marriage, or having a same-sex domestic partner. There are specific financial professionals that can help you structure your assets accordingly. One of the topics that comes up quite frequently, and I have another piece of information in the expo, is how to talk to a spouse or domestic partner about your financials. I think for many people, where another person is managing your money, it feels uncomfortable asking questions, or maybe there's a level of defensiveness when you do ask. And there's a lot of tips in this brochure in the expo on how to approach that discussion so that it's clearly a team sport and it's not leaving the money manager feeling defensive or like, why are you asking these questions? And all the skepticism comes in. It is a healthy conversation that should be had. And really, when you think about it, God forbid, something happens, the emotional toll of that is big enough without scrambling to figure out your financial situation. So I put that into like life. Life throws a lot of curveballs at you. This does not need to be one of them, right? Retirement is so exciting. And a lot of people have a lot of goals. But understanding, like, how are you preparing for retirement? A lot of us, if we choose to retire in our mid-60s, may end up being retired for 30 years. So how are you going to fund your lifestyle? What's important to you, or what do you think might be important to you, just to make sure you're prepared? And then last but not least, divorce or death, which aren't pleasant to think about, but it's better to be prepared than not. So today's discussion, we're going to talk a little bit about the challenges, more in the vein of knowledge is power, purely for awareness, not trying to be Debbie Downer, but it is something to just keep in the back of your mind as you think about your plans. We're going to talk about setting goals, organizing our finances, and then preparing for the unknowns. So the great news is that we're living longer, right? Women are living, to almost, the age of 87, which is pretty amazing. Men are even enhancing their life expectancy to age 84. So what does that mean? Well, it means if you're retiring at the age of 65 and you're planning to stop that income that you would get from being employed, you need to plan for a little over 20 years of expense without matching income if you're not prepared. And so just being aware that, okay, you're living longer, how are you going to fund that lifestyle and live your best life in retirement, which many of us are looking forward to. Some of the challenges that we have to overcome as women is we do tend to earn less. And I'll show a slide in a little bit. There's a lot of discussion right now going on about closing that income gap. And we are making progress. I know that many of us are trying to do our part, but it's going to take time. And the reality is that most women do have lower retirement income than men because of that. If you're earning less is going into Social Security, and less is probably going into a potential, benefit plan, whether it be a 401k that you're contributing into and your employer's matching, or a 403b plan or something else. Women also typically spend more on medical care. I attribute that to we are more regimented and prescribed on when we go to the doctor, and we do a lot of self-care. We invest a lot of time and understanding, and we do invest in our wellness, which does pay off, but you do spend more over time making sure that you are healthy and living your best and healthiest life. We spend more time out of the workforce caring for family members at times. So when you think about it, like I have many friends who worked and probably until their early 30s and then stepped away to raise children for, let's say, 5 to 8 years, and then went back to the workforce. And that's wonderful. And I don't think they would change a thing. But when you look at those 8 years, in your early 30s to your late 30s, where you could have been contributing to Social Security or other, retirement plans, when you look at it through that lens, that's a chunk of time where you weren't saving money as much as you could have been had you not made that decision. Again, not that anyone regrets that decision, but it's just a reality that we have to face and plan to overcome. And then last but not least, women are more likely to enter a nursing home, which isn't a significant expense in retirement. And there are solutions to help offset that expense, but just to be aware that there may be a funding expense component, just to make sure you're incorporating that in your plans as well. So I just want to touch on 2 other slides before we get into the planning. This slide shows you, if you look at the age 50 right in the middle, you can see that for a similar professional degree and job, trajectory, a 50-year-old male would make $100,000 a year-ish. And women would make about $70,000 for the same job. And again, that gap is closing, but it's not going to close over time. And when you look at that, it's important just to know that our potential to save and make that money work as hard as possible is really what we need to focus on, because every penny counts. We also, given what I talked about, when you extrapolate out the time out of the workforce, it could add up meaningfully. So, a little bit less than 300,000 or more a year of lost wages. And when you remember, when you're working, part of your income goes to fund Social Security so that you can count on that income stream when you're older. And so you're contributing less. So ultimately you're going to get a little bit less. And the other piece of it is the retirement plan component. If you're not working, you're not participating in a retirement plan that one of your employers could offer. If you work at a company that offers a traditional defined benefit plan, that's a huge benefit. And I think oftentimes, because it's not cash compensation, real, like near term, we kind of put that off to the side and discredit it. But that is a huge plus, and less employers offer it. But what that is basically your employer setting aside money without you having to do anything for your retirement. So it's just an extra source of income when you pull the retirement lever. More and more employers are offering defined contribution plans. So if you're in a public company or a private company, you may have heard of a 401k, whereby you contribute part of your income on a regular basis out of your paycheck, and your employer will match up to a certain percent. I highly recommend, at a minimum, contributing as much as you can up to that max, because it's a great tool to start to accumulate income, and you don't even really miss it. It's coming right out of your paycheck. You don't even see it. So if you get into that habit early, it's a great habit to have. And then over time, you're accumulating this wealth that will also act as another income stream in retirement. If you work in a healthcare system or a hospital, not-for-profit hospital, you may hear 403B, same type of thing, where you're setting that money aside for a rainy day so that when you pull the retirement lever, that's another source of income that can come your way and fund your best retirement lifestyle. So as we think about retirement, women do tend to have less than men. So for instance, when you think about Social Security, and we got to watch, right now it's funded, but the number of retirees are almost outpacing the number of pre-retirees who are contributing to Social Security. So depending on your age, you may or may not realize the full benefit of the Social Security funding that many of our parents will or have had. So we need to plan for that. I tend to haircut that a little bit. Then you add any of the retirement income plans that you may have participated in at work, and just understanding where those income flows are. And then any of your savings that you have on the side. And that's really what you're trying to solve for. What is the money going to be coming in versus what you plan on spending and going out? We spoke about the nursing home expense. So that's just something to plan for as well, in addition to any of your, traditional expenses of, housing, food, fund money, all of that. So now we're going to shift gears into organizing your finances. So this is really a great discussion, whether you're a single mom or a single female, or, you're married. What are your goals? It's fun to talk about retirement, but what are your goals? Like, how do you want to live? What does a happy retirement look like for you? And then once you know that end state goal, how do you backtrack and think about, all right, what do I need along the way? I was lucky enough growing up. My father was in the financial field. He led a healthcare system, but was very conservative in his financial planning. And so he spoke with me when I was in college about the importance of protecting your loved ones and potentially having term insurance, the importance of saving money early, by, investing in a retirement plan that your company may offer, or working with a financial professional to start setting money aside. And Meg's going to talk about this next with the fixed income approach. Other things like disability, like if I were to get disabled, what would that mean to my family? It would be a loss of income. And not only that, they would have to pay for the expenses to take care of me. So, do you plan for that? Did I want to help fund my children's college savings or wedding funds? All of these things. So think about your goals and list them out, just to start to prioritize them as well. What are the need to haves and nice to haves, and how can you start to chip away at each? And then there's a worksheet. So there's a worksheet I'm going to show on the next slide, but there's also a sheet in the expo that will help you kind of, bucket this out. So for instance, how much do you have in savings and assets? Do you have, a home that you own or a car that you own? Maybe some collectibles, cash, investment portfolios like stocks. Take an inventory of what you have, and then line that up against your debt and liabilities. Do you have credit card debt? Do you have a mortgage on your home? What money do you owe? What money do you spend? And look at, do you have surplus or are you in the red, right? And that's step one. Like, and how do you right size that? And then with your surplus, you figure out, okay, this is how much money I want for fun money. This is how much money I need to live. This is how much money I want to save. And you break it down like that, and you can make small changes along the way, just like my caramel macchiato example, to start to move money between those buckets and make positive shifts that will help propel you, and they accumulate over time. So this is just an example of the worksheet that's in the expo. It's a little bit more built out in the expo, but this is a sample sheet that you could complete. And then other things to consider. Managing newly acquired wealth. So if you were to inherit money, or you think you might be, inheriting money, how do you want to spend it? What are the wishes of the individual sharing that wealth with you? Investment. What is your investment mindset? So I happen to be very conservative. My husband's a little less conservative. And how do we get on the same page? And we've worked with our financial professional to do this, to invest in ways that provide comfort and not more angst. Some people are much more risk tolerant, and there are investment vehicles for all of that. So what they'll do is a personality quiz with you and understand how much risk you're willing to take. And just, speaking from experience, I get made fun of a lot. I'm very risk averse. I would rather give up a little upside of what I could make to make sure I'm not losing money. And so you can find that financial professional that will work with you to get a happy medium, and you'll still be, earning interest on your money and growing your assets accordingly. Thinking about giving to others. Like, are you involved in church? Are there charitable contributions you like to make and that make you feel good? Taking care of your family. These are other things to consider. But the most important thing I really would love for all of you to take away is the record keeping component of this and the storing of the financial documents. So I remember when my grandfather passed away, he had nothing written down. And my grandmother is still alive and thriving at the age of 93. And it took their 4 children, I think, almost a year to figure out everything they had. It would be like they'd get something in the mail and be like, oh, he had a life insurance policy. Or, back then, I don't think they had email at that point. But now everything's in email. So how do you know what you have? Don't force your family to deal with the emotional hardship of having to deal with you passing away, and then also having to cobble together all the financial documents. Make a list of what you have, your bank accounts, maybe even passwords, and put it in a safe place, a safe, or with a family member, so that you know where everything is, the policy numbers, what it is, and just make sure you have a list of all that, because a lot of things are all over the place. And if you change jobs, you could have money in many, many different places. So I cannot stress enough the importance of record keeping and storing of your financial documents. And then preparing for success. So life happens, be ready. These are great questions to just ask and put your mind at ease, and think about who can help you in an unexpected situation, and have that conversation with them so that there aren't surprises. What happens in an emergency? What if you live longer? What if you become disabled or die unexpectedly? Do individuals know your wishes? And just make sure. It could be a friend. I know all my friends know my wishes. And that makes me sleep better at night, that I know that God forbid something happens to me, my friends know, what I would want with my children, our finances, some other things as well. And just a checklist to leave you with, know who your financial professionals are. There's a number of ways to find a financial professional. Don't feel obligated to fall in love with the first financial professional. You need to be comfortable with this. This is your hard-earned money. You want someone you trust, someone who gets you and understands your risk preferences and can help you feel great about the steps you're taking. Save and invest automatically. I think it's a great habit to get into. When it's not in front of you, you don't even miss it. So, start to just funnel money away into a savings. You'll be surprised at how quickly it builds. Ensure that income lasts as long as you do. Again, you work your butt off. Make sure that when it's time to enjoy it, you have assets that can help you live your best life in retirement. Plan to live with dignity. Make sure your wishes can be complied with, and that you're prepared financially to fund that. Tell your loved ones what your wishes are so they can help you plan accordingly. And last but not least, write it down and make sure you keep your important documents updated and organized. And with that, I just wanted to end on, there are many solutions that may help you. So if you're sitting there thinking, I don't have enough cash, or you're not sure what you have, this is the purpose of some of these solutions. So I spoke about the 401k, 403b plan. There are a number of annuities that can help, disability insurance, life insurance. I know these terms sometimes are tricky. There's a lot of descriptors that go with them that may be a bit foreign or not as well known. This is where financial professionals can, break it down in plain English, and you can make that decision to see what might be right for you. And in addition to speaking to a financial professional about it, there are resources to educate yourself. So for instance, the Alliance for Lifetime Income is an organization, and you can go to www.protectedincome.org. There is a wealth of knowledge there, trusted sources. You can get a retirement score to see how ready you are for retirement. It's just a phenomenal resource that is free of charge to use, to help you think a little bit more and educate yourself about retirement and potential long-term care needs, disability, other solutions there. And then the Bright House Financial homepage, our team puts a lot of work and investment into education around retirement and hybrid life insurance solutions. So there's a lot of great content there as well. And again, our expo at the Women's Symposium has a number of materials out there to support whatever you may be going through. So feel free to check that out. So that is all I have. I will turn it back to Mara.
Well, thank you so much. I am pleased with your presentation, and I really think that paying attention to record keeping, as you had said, is very important, because in an emergency, it's like, where's all this stuff? And I've seen it time and time again with families. And recently I had a story of a family that did prepare, and it really took the anxiety level down a little bit. So I think these are fantastic points, and I'm so gracious for your presentation, Megan. Thank you so much. All right, so let's see here. There's a little bit of technology, and Megan will bring you back in a little bit. I'm going to bring Meg Bavaro up, and then we're all going to have a Q&A session. We did have a few different questions submitted in advance, and so we'll see you back in about half hour. How's that sound? All right. Well, what I'd like to do is introduce our next speaker, And this is going to be Meg Bavaro, and she's from PIMCO. They're a U.S. global wealth management company. There we go. Ms. Bavaro is a vice president and advisor consultant covering the northern Los Angeles area of the California coast. Prior to joining PIMCO in 2020, she was the Southwest Regional Sales Manager at Wells Fargo Asset Management. Over her career, she has marketed an array of financial products to investment professionals, private wealth managers in LA, Hawaii, and she often presents at many financial conferences. She has over 31 years of investment experience, holds an MBA from Pepperdine University, and undergrad from University of California, Los Angeles. Okay, her tenure in the industry is over 30 years, and her passion points is that she loves to travel. She has visited over 80 countries on 6 different continents. So I'd say she has a good point of view on things. She also is an avid scuba diver and has traveled to the Great Barrier Reef. She's ice climbed in Iceland. She's safaried in Kenya, and she has paraglided in New Zealand. Meg enjoys giving back to the community and elevating individuals through their knowledge of finance, and thinks it's an integral part of all of us growing. So without further ado, I think I'd love to have Meg here.
Perfect. Thank you. Can you hear me okay?
Yeah.
Okay, let me go on and share my screen and bring up my presentation. And why isn't it? Hold on, let me try this again. It was working before. It's
got this, Meg. And
let's try this one more time.
While you're bringing it up, there were some really great news, headlines this week that shine the light on where women are today. And I'll just read a few of them to you. From Christmas trees to kids' lunches, product shortages continue to hamper shoppers. Costco has even reinstated purchase limits on toilet paper, paper towels, and bottled water. All right, you're up and working. Take it, Meg. Thank you.
Thank you. So thank you so much, Mara, for the kind words. And I really enjoyed Megan's talk as well. I think it's interesting that education is so key, and just developing ourselves and whatever we're interested in. And I'm always learning and trying to elevate and do things that make sense, not only from my own educational experience, but things I can share with people. And one of the things Megan had mentioned was taking advantage of some of the firm, if they have 401k matching, et cetera. And that's key. And as we, deal with the younger generation, I have a lot of godchildren and extended family. And one of the things that they all come to me now is, okay, what do I do? How do I take advantage of it? Because they understand the importance of starting to save for the future now. So again, thank you for that. And I really enjoyed both your opening comments and then Megan's. So PIMCO is known for fixed income investing, where we just are celebrating our 50th anniversary. We're one of the premier fixed income managers globally. And what we're going to talk about today is really about bonds and fixed income and what they are and how they work. Obviously, this presentation is available in the booth as well, I think it's called the booth, the expo. Happy that you can download it, no problem. You can also go to pimco.com for other resources that are available from an educational standpoint, and if you're interested. So without further ado, we're going to talk about, what are bonds? And I kind of laugh and say, okay, bonds are in the very basic thing is, think of it in a municipality that if someone wants to build a school, they're going to put a bond out there. And we always get the bond measures on the election ballots every year. So they're going to put out a bond, and people are going to buy the bond, and they're going to get an interest for it. And a lot of times it's over a fixed period of time. And that's really what a bond is. It's just something going out there to raise capital to be able to do something with it, in the very simplified form. governments have been using bonds, and during this whole pandemic, one of the things that I think we were all binge watching everything, and I binge watched the Medici saga, and it was interesting because they actually used bonds in it and to raise capital for different things. But this actually goes back to the 1100s when Venice was doing it, and they taxed and they created the bond. So if anybody was asking you when it happened, it was in the 11th century, 12th century, whatever that century was, a long time ago. But it's interesting. If you think about it, there's multiple types of bonds. And so there's the government or the sovereign. And I think we all hear about it when we hear about the Fed. A lot of times the government, the treasuries, that's probably, if you had to categorize it, it has the least risk of all the types of bonds that are out there. Then you have more like municipalities or states that will have bonds that they issue for different things. That'll have a little bit more risk. Then there's corporate. And think Apple, think those types of companies that are issuing bonds to be able to do something within their firm, whether it's to go into a new endeavor, maybe it's to build a building. And then they're securitized. And these securitized are backed by assets. So think if a cruise line is issuing debt, they might back it with a cruise ship, right? Or if an airline is issuing debt, they may back it with a plane. That's called securitized debt. So those are the main asset classes that are available. People a lot of times will ask on a bond, what's the coupon? The coupon is really what is being offered to the person purchasing the bond while they wait for the bond to mature. So if there's a 5% coupon, it would, on a $1,000 bond, it would be $50 a year that they would then get as the income. And that's very simply how it is. And it's just a percentage of the bond face value. So if you look at it and you say, okay, what is a bond's yield? So a bond yield, and the way I like to think of it is, and I think we all experienced it, if you go to buy a carton of milk today and it's going to cost, let's just say $3. And if you go in 20 years, that carton of milk will not be $3 anymore. It'll be $5. So that's the inflation. And that's what comes into the yield, is when you look at the bond and say, okay, I'm going to get 3% now. So I may get, or in the previous example, I may get $50 a year, but I can't do the same thing with that $50 in 20 years. So that's the bond yield in very basic form. Negative bond yield. And I think we've heard, if you hear that term in the news, a lot of times it's when it's coming from, and we've heard it from Japan, they've had a lot of negative level. And it's basically when the increase for the demand for the bond prices pushes the yields down so that it turns negative, so that it's a feature that's happened, that when the central banks are spending too much money to refloat the economies, it pushes those bond yields negative, which we hear. It doesn't mean that you're paying them money, but it is a inflection point. We've seen it in Japan several times, and then Germany most recently. So what determines the price of a bond? And we get this question a lot. And I think when you look at fixed income and you have to say, okay, you saw the different categories that we had, correct? So we have all the categories. And then it comes down to what's the quality of the company? How big is the coupon size? So what's that percentage? When's it going to mature? Right? So high quality, if you're thinking Apple is a very high quality company. It is something that we all are very well known with. They're not going to pay as high an interest as, let's say, a company and that's has more risk in it, or that is not as high a quality for a myriad of reasons. So what happens is that all factors into how the bond price of the bond happens. And then you have to factor in what's going on with interest rates at the time. So there's a lot of different moving parts with bonds when you go to buy bonds or when you're investing in bonds. I like the seesaw. One of the things that comes up with the seesaw effect is that, if prices are falling, yields are going to go up. And if prices rise, yields fall. And what does that really mean? So we're going to talk about in this next section. And one of the things that comes up is, what is the spread? And I don't know, unless you're really listening to a lot of the financial channels, you probably don't hear it as much, but just the spread is basically, if you have a government bond, which you remember we talked about is the most safe, risk-free, so to speak. And then you go out the risk spectrum, right? So you go from, let's just say, government to municipality to corporate to a more risky type of corporate. And there's a spread. So it's basically that you're getting paid, not you personally, but the bondholder will get paid to compensate for the risk that is taken. That's what the spread is. At times they're very narrow, and at times they're very far apart. And that's always what's part of the mechanics of a bond and what's going on in the fixed income market. So duration helps us calculate the bond price given what's happening in interest rates. So I always like to talk about this from, and we just went through the pandemic, right? So I started with PIMCO right at the beginning of the pandemic, and I was going through it, and we saw what happened. If you held duration last year when rates were falling, so when the pandemic hit, even though it was a healthcare situation, it created a liquidity crisis in the markets, and we saw interest rates fall. And so what that does is it will make it literally start, if the bond prices are falling, it then makes the duration comes into play. So if you held duration when rates are falling, you actually did okay. If you think rates are going to rise, you're probably going to want to stay shorter on the duration. Think of duration as number of years. So if you invest today and you think rates are going to go up, right? There is an issue of, okay, I'm investing at a lower rate today. If rates go up, I can reinvest at some point at a higher rate, and then vice versa on the duration. It's always a topic that comes up, and it is a little, I would say, counterintuitive on some of these items, just because of the way it does work, and you have to get your head around it. So if you're going, I don't understand this, you're not the only one. It takes a long time to understand it and see what it's made up of, whether it's duration or interest rate risk, etc. So credit quality. I always like to talk about credit quality and go back. So you have Apple. Apple is, and I think I use that example most of the time just because it's a good, solid company, and it's been around for a while. It's considered, a higher quality. And then you have, and because it's been in the news so much, you have a company like Evergrande. That one, and even though it's a different country, but it's still a company. And that one obviously has a much higher risk to it right now, if you're thinking about it. And you know that you're going to get, if this were to play out in a different world, you would get compensated for investing in a much riskier type of a company, versus an Apple, say, or one of the more safer ones. So again, if you take a look at it and you go out this spectrum, you start with government bonds, then go to quasi-government, corporate, investment grade, and then speculative. And they go out the gambit. And keep in mind, just because if it's a speculative grade doesn't mean it's bad. It just means that company is, or it could even be a municipality, it could be a lot of different things, may have something going on with it, and they're willing to pay more for you to be able to be invested with them. Okay, so let's go into yield curves, and this is another one that may not be the most intuitive. And I always say, so if you're going out and you see the chart on the left where it talks about, you see it going from a maturity out, that means it's growth, it's a normal curve. Usually what we'll see is an inverted yield curve, which is the chart on the right, where it shows that maturities are coming down, yields, there's something going on in the marketplace that's going to cause an inverted yield curve. So if you talk about it, what's the worst thing that can happen to a bond portfolio? And I think one of the things we say is like, okay, the worst that can happen is the payments are defaulted on. So the bond is not going to pay off. they're not going to get their interest payments, and they're not going to be able to pay the bondholders. Now, keep in mind that the way it usually works for a company that's insolvent is bondholders get paid before stockholders. So think fixed income gets paid before the equity gets paid. And that is, one of the things that's the worst that can happen. A lot of times what you'll hear, though, is the default rates remained very low because a lot of times there's restructuring deals that go on, which means they've got a good business model. They just need to restructure it for a multitude of reasons. And that's not necessarily, always a bad thing for the investor. Sometimes you just have to wait and be patient. Sometimes you don't get back all of your money, but you get back some interest. So there's a lot of different things that can happen. But the good news is over the last decade, between low interest rates, the default rate has also been very low within corporates. So best thing that can happen, and we laugh, is you get back all your money plus the interest. Your expectations have been met, and that's a good thing. And it could be you were going into it for capital preservation. You could be going into it for income. So what is active bond management? And I think one of the things that we have to talk about is active management is where the manager's actually investing with the goal of outperforming a specific benchmark, versus a passive manager is going to basically buy and hold what's held in the benchmark. So when we talk about adding alpha, active managers are out there to add the alpha, where passive managers are out there to, meet the benchmark that they're set up against. And I think one of the things, and we'll talk a little bit more about the size of the bond market, is the size of the bond market is so much bigger than the equity market. But on top of that, a company can issue multiple bonds where they're only going to have one equity ticker, so to speak, but they could have 100 bond issues. And so it makes that market very complex, and you've got to really delve into each part of it. So this next section is all about, what's your purpose for investing? Do you want capital preservation? Are you looking for income? Is it simply a diversification? With everything we're hearing about inflation right now, is it something about inflation protection? Is it capital appreciation? So usually there's a goal when you invest in fixed income. And the goal is really to outperform cash or certificates of deposits. I think that's one of the things that they talk about is, investing in a CD, you get paid very little, cents on the dollar, where if you go out a little bit and are able to invest in even short-term fixed income, you can increase your return. So again, when we talk about this, the bondholders usually get paid before the equity holders. But because of that, the demand is usually higher to hold the stocks than it is to hold the bonds. And so then bonds usually have a little bit less of a return, but they're more like, I would always call it the bottom of the pyramid when you think about that. So again, bonds are driven not only for their returns by coupon, duration, spread, which we talked a little about, where stock is really driven by the earnings. So it is it's a little bit more complex from the bond market. We talk about why do they get, we hear a lot about equities. So you're always hearing about Tesla or Apple or, all the different tickers that are out there. And it's because the bond market is so much more complex because of the amount of issues that are out there that makes it so much more challenging when they're talking about it in the news. So why are bonds linked to interest rates? And that's always a good question and it's the supply of capital offered by the lenders and the demand put forth by the borrowers. So that creates an interest rate, and then they adjust their coupon to be in line with what the interest rate is going. So for instance, when liquidity is a little bit harder to come by, so if rates were high and liquidity was harder to come by or costly, they might offer a higher interest. Whereas if money is cheaper and things are things are more liquid, they could offer a lower interest rate. And again, a lot of this could be counterintuitive, but I think the big thing is when you're thinking about investing, you have the equity side and you have the fixed income side. And we're really fixated right today on the fixed income side. But it really comes out to when you're putting your plan together to know and understand the different markets. If you're working, as Megan had talked about, with a financial advisor, and you're trying to get more information, it's having that baseline to start from. And one of the things with active management, it can be very simple, where I'm going into a lot of the complex details. Not necessarily important for you to understand it all, but just understand that there's a lot more behind it than you would normally think. So, and then if you think about, bonds see it first, and you saw on those curves, that curve where I showed the inverted yield curve, that's what they were really talking about, is a lot of times the bonds look at the health of an issuer, they look through the company balance sheet, and so they'll react quicker than, let's say, a stock, because stock is based on future cash flows. Talking about the size of the market, and 30 trillion versus 40 trillion, it's also, keep in mind that it's not just a company issuing, it's governments, it's municipalities, etc. And so that makes the market so much bigger. When they talk CUSIPs versus, and that's what's assigned, it's like the trading symbol that's assigned to the bond, I guess is the best way to say it. And one company can have, like I said, 100 issues of bonds, but they'd only have one ticker symbol for the equity side. So, and again, when the market and the liquidity, you're trying to match, and this is what the managers do, and this is where their challenge comes in. And when you're an active manager, you're always trying to make sure that you understand the bonds with the characteristics, maturity, coupon, duration, whether it's the financial crisis or regulations. You've got to take that all into consideration when they're analyzing a bond, which is one of the things that when you're doing the market with the equity side, you don't have as much to analyze as you do on the bond side. And that makes it a little bit more challenging, but also, can also be a little bit more fun, because there's a lot more to look at and understand. And that's also why a lot of times you will see banks and insurance companies invest in the bonds, because they're looking through all of that, and it's what we're going to call a safety net for them, or a good way to be able to invest their money as well. And so we talked a little bit about this with the coronavirus, with the liquid. There were asset classes that tend to be more liquid, some that weren't. We all saw what happened in the marketplace with the equities. And so I think it's important to understand that the health crisis was one thing, and then the asset side of it, the reaction to it with the liquidity, was the other side of it. And then it quickly bounced back. But we did have a lot of, obviously, volatility in the market. And then, obviously the Fed jumped in to help try and support the markets as well. So how do you invest? So we talked a little about there's mutual funds, you can buy the actual bond itself and hold it till it matures. There are ETFs, a lot of different ways that you can invest in the fixed income market. But again, one of the things that we always talk about is you have to figure out your risk and reward of what you're looking for. And that's really the key. When are you looking to use the money? What are you using the money for? Is it for income? Is it for capital preservation? Is it for capital appreciation? That all that goes into the goals, which goes into your plan for how you want to be invested in the fixed income world. The old adage, and it was kind of interesting, the old adage used to be you would take your age and subtract from 100, and that's what percentage you should have in fixed income. And so, or equities, depending on how you're looking at it. So I always laugh. That was the old way. Now we actually have software that talks about it and goes through the Monte Carlo simulations and really helps you to put together a plan tailored to your needs, not just tailored in general. And then if you go to the next step, which is, how do you professional managers run their portfolio? I know at PIMCO, we look from the top down and come up with what we're from a macroeconomic standpoint. And then we also then obviously have to look at, what we're investing in and really do the research for each issue that comes up. So again, there is risk involved with the investing in bonds, as in investing in anything. But again, you've got to take that and balance the risk with the reward. And again, you've got to put it into your plan. If you're younger, you may be willing to take a little bit more risk. If you're older, you may want to take a little bit less risk. Again, are you doing it for capital appreciation, or are you doing it for income? So we talked a little bit about coupon, duration, spread. One of the things we didn't talk a lot about is the foreign market and investing in foreign, whether it's currencies or bonds over there. And we can save that for another time. But just keep in mind that the global bond market pretty much all operates the same way. But it is, you've got to look at a lot of different things when you're evaluating a bond. And then credit risk is, and we've talked a little bit about this. Credit risk is the type of company that, I'm simplifying it, but it's the type of company you're investing with. Are you investing with a well-known company? And I would say, whether it's a Tesla or an Apple or one of those, or is it a company that could be a little bit more out on the curve, where, we look at a municipality such as like the city of Chicago, or the state of Illinois. You heard about Puerto Rico and some of the bonds there. That's all the different credit that comes into play, and understanding how to evaluate it, and then how to then put it within your portfolio. And that's really, I always suggest working with an active manager. That's one of the things that they do so well. And then working with your financial planner, and really understanding what your goal is. So, and going through this, when we talk about the income, again, if that's your goal, some will pay monthly, some will pay quarterly. It's on a schedule. Some may pay annually. So it's something that the bond issuers is think of it like an interest payment that you get at the bank. You would get your CD interest, and then in the bond you get the same thing, which we talked about, which generates income for if that's what your goal is, then that would be the type of bond you would invest in. So, and a lot of this comes down to, do you get a cap gain? Is the bond that you bought at a lower number than picking up to a higher number? And sometimes, you're buying at a discount, you hear that term, or you're buying at a premium. And that is all dependent on the market environment at that time.
Megan, this is amazing. Meg, this is Mara. It's amazing information. And we are now running forward with our agenda and schedule. Would that be okay?
Yeah, I think we've pretty much gone through it. And
let me give you a minute to
questions.
All right, what I'm going to do is bring Megan Dosher to the table. Meg Bavaro just finished a phenomenal, great presentation. There's a lot of new words out there. I'm just going to throw it out there: duration, coupon, maturity, yield, credit, equality, curve, alpha. There's bond. There's a lot out there, and so I hope a lot of these new terms, if it's the first time you've heard it, just start getting used to it. I think it's like you got to hear 7 times before it sinks in or whatnot. But just to get this kind of exposure from such a bright woman like Meg Bavaro. So I'm really, really excited. And for those of you out there, there's the stock market, there's the bond market, there's the cash market, and there's insurance and annuity market as well. So there's almost, and we could talk about alternatives, but really 4 big asset classes that you can choose to invest your money. And the stock market is, if this is the stock market, we got the bond market that's about 5 times as big in size and money. And so one of the reasons Women's Symposium wanted to throw down with bonds first is it is the biggest investment market in the world. So without further ado, we're going to take some Q&A from the audience. I have some prepared for you ladies, and Thank you for sharing some notes. If anyone else has some questions, just go ahead and text them in the stage chat or in the Q&A chat. But the first one we got was for Megan Dosher. So Megan, you touched on the pay gap difference between men and women. How can this be addressed? And do you have any talking points to get the conversation started?
Yeah, well, that's a great question. And it is eye-opening. And I will say the good news is a lot of conversations are being had very actively across industry at the right levels. So that's the positive thing. I think all of us as women can do our part to advance the conversation. What we're starting to see are what are called pay audits. So driving transparency between who's getting paid what at what level, and just having that added transparency fuels the right conversation. So there's those, you see it now, like some companies are talking about posting salaries at each job level. And as leaders of teams, it's definitely challenging to manage because all, things aren't created equal, but it is a step in the right direction, having that transparency. I think the other piece that more and more companies are talking about with their HR partners are the family leave and flexibility upon return. So a lot of what I think we've all probably seen is what is it like once you leave to take care of a sick parent or child, right? Like, can you balance and do it all? That famous, like, do it all saying, right? And more flexibility will help women make the choice and make it seem doable that they can stay in the workforce and not step away from that income, which over time will cause the gap to widen. And I think, there's two other things we can do. Make sure we're increasing access to childcare and the quality of childcare. So more and more women feel like, their children are being taken care of and they can enjoy a thriving career. And not making the decision to leave the workforce altogether to raise their children. There's that, happy medium. And then just continuing to develop in female talent so that women are getting the exposure and additional experiences to take on those higher jobs that are paid more. So those are just a few things that are very active conversations across industry groups. And I can say at many of the financial services companies that are going on right now. It's a great question, though.
Thank you. Thank you so much. Meg Bavero, we actually got a question for you as well. And we have, what is alpha and why is that important?
So alpha, no, I was going to.
I mean, we all know about the alpha male, and that's the first time.
Yeah, that's I was going to go with that, but I was like,
elevate the alpha female. Let's do it.
Yeah. So the alpha basically is the excess that, if you just buy an index, you're going to get the index, right? So the alpha is the additional benefit, I guess is the best word to say it, or additional return that you get by investing. So alpha is always important because it's usually more. What more are you going to get by investing? And it could be equities, it could be fixed income. It can be in a myriad of products, but what's the extra or to make alpha be value add? How's that? What's the additional part that you get?
Right. So if you're expecting 2% return, whatever investment, and you got 3, you had a 1% alpha.
Yes.
All right. Just checking.
That's the easiest way to describe it. Yes.
I did have a few more questions that were submitted ahead of time, and ladies, keep them coming. This is phenomenal. I feel so overwhelmed. I just don't understand this stuff. Where do I start? So we can let both Megs take that away. We'll start with Megan Dosher.
Yeah. Well, I think attending today is a great first start or second start. And having the conversation, talk to a trusted friend. There are so many resources. So like the resources I shared, have a conversation with a financial professional. They get it. Keep asking questions. I'm always someone who asks. And while I've been in the financial services industry for 25 years plus, I still ask a lot of questions. It doesn't always sink in. So it's not you, right? This is the challenge with a lot of insurance and wealth management companies trying to break down something that is intangible. You know, we're spending a lot of money and we're trusting, you know, people with our money. It's not as easy as buying like an iPhone that, you know, okay, I can hold this, right? You're buying a promise. So just keep asking questions. Everyone is asking questions. We need to do the same, and don't say you don't get it, because if you don't get it, you're not speaking to the right person. And there's plenty of resources out there that can help make that match for you.
I have to say, I didn't get it for a while, and that's okay. And it's those incremental steps, and you know, it just is a good place to start asking questions and becoming familiar. Meg,
and I would just say, and it's funny, Megan, I'm going to bring up, I know in your expo that you've got the checklist, et cetera, and charts, whether they go to your website or our website. I mean, there's a lot of different, I'm sure, Mara, it's on your website. It's a lot of different educational tools. And so I would say, do the research, look up online. There's a lot of good YouTube videos actually on it. But ultimately it's have the conversation and ask the questions. And one of the things we do really well as women is we will tend to ask a lot of people. And that's what is, you know, ask your friends, talk to them what they're doing. It doesn't hurt. You never know who's going to be involved or who might know something. And so it's always good to ask around of your peer group as well.
Women's Symposium is one of those safe places where every question is a great question. So if it's a beginner level or if you're very experienced, we're here to help you. I forgot to mention, as I have one more question that might be coming in, that Megan Dosher's company manages over $200 billion.
Yeah, assets under management.
Assets under management. Meg Bavero's company, PIMCO, manages close to $2 trillion in bonds. And I work for, in my day job, Wells Fargo Advisors, and they're managing a few trillion as well. And so the wealth and knowledge you have right here between these companies and the breadth and scope, we're here for you, ladies. You just tap our shoulders and we will give you all that money matters and everything we know. One of the questions that did come in was, what is the difference, and I believe this is for Meg Bavaro, what is the difference between an ETF and a mutual fund?
So, and actually, Maura, I'm going to actually pivot that back to you. I mean, I can explain what an ETF is, an exchange traded fund, but I'm going to pivot that back to you and let you answer that one, since that's part of your day job.
All right. So it is. There's mutual funds is a pool of investments. It can be cash, stocks, bonds. And so a mutual fund is where we all participate in the same investment. It's a mutual investment. And so there's a company, it could be PIMCO, that's trading these bonds all day long and trying to have that grow. And so at the end of the day, the basket's going to price. Did they trade well that day or not? And it could not, maybe it's not their fault. Maybe it's just the general economy risk or whatnot. But mutual fund will price at the end of the day. An exchange traded fund came out, gosh, right when I started in the business in the year 2000s, late 90s. And essentially, I'm going to use the S&P 500, which is the top 500 companies here in the United States. It's an index. And so it's a benchmark that we can kind of grade different investments off of. So we can buy the S&P ETF or an S&P mutual fund. So the ETF actually values throughout the trading day, where a mutual fund is going to price at the end of the day. Exchange traded funds trade like stocks. You put limit orders on. I want to buy here, sell there, short it, maybe leverage it, whatever. So you could be a little bit more quick and nimble with ETFs, and they're usually most likely pegged to just meet an index or track an index, be the S&P, where a mutual fund historically is trying to beat the S&P index. And I think that's the difference between mutual funds and ETFs. You can accomplish the same goal. It's just about how are they traded and what are the fees involved. I think that was a good answer, but
well done. Yes.
Bravo.
I think it's really important as the day continues that if any women here have the need for questions, just tap any Megan, myself, instant message us. You're going to have our emails as a follow-up. Both of these smart, intelligent women are not in sales. They interact in the executive back part of their offices and support other folks in the business. So you're getting really the top of the chain when you get to ask questions here. I'm very, very ecstatic and thankful that you both made time to join us today. I think it might be a good time. Let's see here. I have all different widgets and we're all trying to figure it out, but I hope it's working. I know in the beginning, the presenter mode wasn't, but we did our question and answers. Now I'd love for you ladies to take the time. Don't forget to do our evaluation. And I put that in the text chat also. We're going to have the sponsor and partner booths open. I want to make a few announcements. We have our 6th annual Women's Symposium. Save the date for next March. It will be a hybrid in-person event, and I have a soft, almost a hard confirmation that we'll be doing that at DeVry, Long Beach. So thank you to Laura Knapp, one of our volunteers here at Women's Symposium, for offering her school for us. We will also be rolling out the Empower Web mentorship session right after this. It will be an open dialogue on the program. We are asking for you to participate. Essentially, I will give everyone here today a complimentary opportunity to join into the Empower Web mentorship program by Wssc, and we're asking that you invite one other individual with us. So at this point in time, I'll let you do some networking, which is almost like a speed dating. There'll be a little auto matching. And I do want to thank both Megan Dosher at Bright House and Meg Bavaro at PIMCO for being dedicated leaders in the space of financial knowledge and supporting women's empowerment. So thank you so much. I also want to give a shout out to the speakers, the volunteers that worked behind the scenes with the speakers, and hope that you enjoy the next 30 minutes or so. Please take the time to follow us on our social media as well, or take the time to volunteer with us. A lot of our news and what is going to be coming out will be getting out through social media and not necessarily email blasts. So please take the time to follow our links. And I hope that you all had a good presentation today, and a good, pretty much knowledgeable experience. So if you have any feedback or empowering things you'd like to share, I know that both Megs and myself are extremely passionate about the space, and just know that you will always have a home here at Women's Symposium. We are going national. So you don't have to live in SoCal to be involved, especially in our mentorship program. So at this point in time, we will be concluding our main stage, and I'll open it up to see if there's any other Q&A before we part ways. All right. Well, woot woot, happy Women's Business Month. I know several of you here in the audience are business owners yourself. You have volunteered for us and been past volunteer program breakout session leaders or keynote speakers. So we are so happy to have you back after the last year or 3. I've seen you in there, and look forward to getting us engaged back again to impact women through just conversations that make sense about financial literacy, STEAM field awareness, and get more comfortable with those problem-solving dynamics that are sometimes challenging. So thank you so much for all of your time, and look forward to seeing you out at the expo. Visit the expo. Both Meg's presentations will be in their expo, plus additional resources. There was a lot in Meg Bavaro's presentation that you might want to go through and just kind of self-check and learn a little bit deeper on. Visit our website, and look forward to seeing you at our Empower Web Mentorship Program kickoff in 2 weeks and our annual Women's Symposium next March. Thank you so much. We are concluded.
Bye.
We'll see you around. Thank you so much.